Vikas, welcome to the ET Now studio after a long time. Why this underperformance? I mean, relative, but in the last 6 months, especially vis-a-vis what the other world markets are doing, and especially the steep recovery in China and Hong Kong. Does that come as a surprise?
So I'll answer the second question
Sure.
first. It's not really a surprise. I think if you look at the significant outperformance of India, and I'll put Indonesia in that also. So you look last year in what was a very tough market for markets globally, across asset classes, Indian equities performed quite well. I would say the Indian fixed income and the FX also performed pretty well. Indonesia, same thing. Now, to focus on India, the absolute performance was positive in a tough year. The relative performance was even greater compared to the rest of the world. I think it would be unreasonable to expect relative performance to continue this year. But I think India remains the most exciting market for equities in Asia, if not the world. And the long-term story remains intact.
Right. Well, the long-term story, you say, continues and is going to be intact. Will the outperformance of other markets continue while India's relative underperformance continues? Will China, Hong Kong be the markets which everyone is going to rush towards?
They can. If they do, they're welcome to do that. If they're selling India, we'll be buying. We're here. And I think if you look at China, Korea, Japan, these are all markets that we were very excited about. We invest across the region and around the world. But India, our allocation of capital, the firm's allocation of capital to India has never been higher. Our levels of cash in the India dedicated funds have never been lower. So if there's any way to express our constructive view on India, I think that's one way to do it. Short-term absolute outperformance should still be strong for India. Short-term relative outperformance, hard to guess. But in the very long term, I see few markets in Asia that outperform India, even in dollar terms.
Vikas, it's interesting that we're meeting right now because of late, with all the ongoings with the Adani saga and a lot of other things, to how a lot of global commentators as well have been watching this entire episode play out. Is there a doubt on the India story at all? I mean, do you get questions and queries sitting out there in Singapore regarding what's going on with the Adani names?
Yes. So that's part of the reason I'm here, because a couple of weeks ago, I started getting questions like the ones I got last summer and autumn. Last year was, is China investable? Are you allocating more money to China? 2 weeks ago, it was, is India investable? Is the India Inc. story dented? Are you allocating more money to India?
And how do you answer that then?
Well, I'm here to answer those questions. And when I start getting questions like that, it gives me a signal that I should be doing the opposite of what others are saying. And as I mentioned, our allocation of capital to India has never been higher. Our cash levels have never been lower. And so I also think the opportunity set in India has never been broader, it's never been deeper. When I was here, last time I was here in the studio was 11 years ago. At the time, if I share some numbers, so Reliance, HDFC, TCS, and Unilever, aggregate market cap was about $200 billion. Just those four companies, the aggregate market cap today is $500 billion, in local currency terms even higher. When we look at how the Indian GDP will grow, how the story will play out over the next 11 years, 12 years, those numbers will repeat themselves across sectors again and again and again. And so we're very excited about this market. There's no kink in the India Inc. story.
So suffice to say that you've been a buyer, bought more of the same, added more positions in the recent underperformance or the decline in India?
Yes, across key sectors. So I think there's a guess just on, if we start with healthcare, for example. I think the Indian healthcare story is intact, very strong. If you look at hospitals, services, some pockets of biotech and pharma, I agree with the view on diagnostics. If you look at IT services, the larger companies, it's not as bad as people think. If you listen to the commentary, if you look at the numbers, revenues are healthier than people thought. Margins are higher than people thought they would be. Banks is one area where we prefer some of the smaller and middle-sized ones, specialty finance, housing finance, not so much the big banks. The scale is such, you have to be more careful. Autos have surprised me, four-wheeler and now two-wheelers. I think those are fertile grounds for long-term investors. We can keep going, there's a lot to talk about.
Yeah.
But I think the point is that if you look over the past 2 decades, there have been so many episodes where you have gotten these questions, I have gotten these questions. If you think about May 2004, May 2009, when the election results were surprising. 2013, the summer, yield curve inverting, currency blowing out, same questions. Global financial crisis, COVID. But the market endures because the earnings growth story is so strong. There are other markets where there's a short-term trade. This is not one of them. This is perhaps the longest dated trade in the world when it comes to equities, and we're here to be a part of that.
It's interesting that you say IT is not as bad. So clearly you're not concerned about US recession. You feel that that's going to only spell more business for India services?
I think it's fair to say we were more concerned about that 12 to 15 months ago than we are today, and the portfolio is positioned for that. Also, the prices reflect that. So if you look at the starting point today compared to the end of calendar 21, the starting point is so different. And there's a lot, what we're trying to judge always is what is in the price and how do we allocate our capital to maximize prospective returns. You look at IT services over the past 15 months or so, and a lot of those concerns are in the price. Now you start looking at the numbers, and relative to expectations of just 3 to 5 months ago, their earnings delivery has actually been quite positive across the sector and concentrated in the larger ones.
What intrigues me on the other hand is, and sorry to jump to not what you don't like, private banks. What makes you so wary of private banks?
I think it's less an absolute concern about the banks, more just a relative positioning and where the relative returns are. So I think if you look at the size of the loan books and the growth that is priced in for them, in percentage terms, these numbers are high, but in absolute terms, it's so large. So where we see better opportunities, not that we don't have good opportunities, we have good opportunities. Where we see more and better opportunities are in some of the smaller companies, housing finance. If we look at housing finance for the lower and middle income groups, I know there are some sectors in consumer discretionary, consumer staples, where if you're exposed to the mass market, there's some concerns, and we can talk about that. But in housing finance, I think that's a very long-term story for growth, and we have our capital there.
Well, how can you be bullish on India and not bet on the big banks, right?
Yes. So it's more a relative bet. So if we look at the aggregate exposure in the big banks that we have today, relative to the rest of the portfolio, it's a little bit smaller, but it's still quite overweight. So we still like them, but we like other things more than we did a few
More the
months back.
corporate-facing banks?
More the corporate-facing banks, yes.
Okay. And I'm going to now jump from IT to the sort of, the fancied IT names, all these tech companies, the new age tech companies, so to speak. And I recall your comment that, you weren't as smart as an Alia Bhatt or a Katrina Kaif when you actually skipped Nykaa.
Yes.
But in retrospect, I'm sure you feel happy about giving those names a skip. Having said that, now that they seem to be on the path of profitability, talking it, delivering it, as did a Paytm, are you now exposed to them, or is it still zero exposure?
So our aggregate exposure to the class of 21, class of 22 tech IPOs is still effectively zero. You can have an issue with a company's valuation or the business model itself. For us, for many of these companies, the issue was not the valuation, although it was that also. The primary concern was the business model itself. And in a world of rising competition, pricier capital, what do these companies do? How do they evolve? And what we've seen in the earnings delivery, or there's not much earnings, even in the revenue delivery, is that our concerns have been justified. And despite the correction in the share price, there's not much value there yet. So there's a small subset of these companies that we keep our eye on, but our aggregate exposure is still effectively zero.
None of it? No Policy Bazaar, no Paytm, no Nykaa, or maybe the unlisted space as well?
Well, so I'll talk about the unlisted space,
Sure.
because I think there are certain areas in B2B e-commerce, in infrastructure build-out, in manufacturing, and in two-wheelers, where we are actually quite excited. Our allocation to new private companies in 2022 was zero. And this year, however, we're making progress, we're doing diligence. It's another reason why I'm here, to meet some of these companies. And I think that story in particular is very exciting, but there's a broader story around that of manufacturing in India that we can talk about. That is very exciting. And so yes, if I look at what could be the class of maybe 2024 or class of 2025 IPOs, the companies that we're looking at today are very exciting, and there's a high probability that we allocate capital there.
Okay, fair enough. I also want to talk about autos, because 2 years back when we chatted, you were completely bearish on two-wheelers,
Yes,
right?
yes.
The stock prices definitely have underperformed, whereas you've got the class of four-wheelers doing what they have, everything from an M&M to TVS Motors actually has been an exception in that bag. But are you bullish now overall on autos, or again, is there diversification, four-wheeler separate, commercial vehicle separate, and are you bearish or bullish on any of that? of the
I'm glad you
names.
remember everything because it makes me look good. But yes, so the two-wheelers did underperform.
Yeah.
I think that, so I'll address that, but there's a broader question. Why we like India, the breadth and the depth of it, is because for almost every sector, you have so many choices. And for active managers, it's a wonderful market because there's such a dispersion. We'll talk about autos in a second, but IT services, banks, healthcare, manufacturing, staples. If you look at the share price divergence, which is a direct function of the earnings divergence over the last couple of years, it's quite material. And today, when we look at two-wheelers, to come back to your question, we expect that divergence to continue. So when we last spoke in November 21, 15 months ago, our effective exposure to the two-wheelers was close to zero. It's not zero any longer. There are some underweights or shorts that we have closed, and the work continues. The work that we are doing on the private side is informing the work on the public side, and vice versa. It's making us smarter on both sides. So the two-wheeler story, I think there's partly because of the pent-up demand, and also because of the shift from these ICE vehicles to EVs.
EVs, yeah.
Yes, and the opportunities that we see, actually the private companies have surprised me to the positive. And the listed companies, I think I would have expected more from them by now. But they can be fast followers. We've seen this in other industries where the incumbents allow people to burn a lot of money, develop products, and then with their scale and their size and their acumen, then they come and they eventually take the lead. That could still happen. This race is not won. We're still closer to the beginning.
But are the
than
ones who are going to catch up on the EV race going to be the fastest ones to win?
It's very interesting. I think if you look globally, the adoption of EVs has exceeded general expectations, certainly mine. I think that I read a stat recently that EV sales have crossed $1 trillion for the first time globally. And if you look at the penetration rates, two-wheelers, four-wheelers, CVs, scooters, personal mobility, all of that is accelerating. Related to that is the component technology, the component industries, the battery industries, energy storage, energy charging. And a lot of those roads lead back to India, China, and Korea, which is why I think those areas are worth looking at as well. And these stories will take a long time to play out. So we'll be able to invest in the space for a long time.
Sure. You know, the other space that you've talked about is the derivatives of housing, everything from home finance to tiles to paints, etc.
Yes.
Having said that, while the boom in the real estate sector was a big move. You know, it was almost an alpha generation if you bet on the housing sector at the COVID lows. But it's not been a very symmetric rise in the entire space, right? Be it derivatives or pure play realty.
Yes.
How are you exposed to the real estate sector at large right now?
So in our portfolio, the implicit bet on Indian housing as a story is perhaps the largest aggregate bet that we have.
Oh, okay.
Now, within that, what's curious is we don't own any of the developers. Our exposure to the developers.
Why is that?
I think there's more operating leverage and more gearing to that story in the derivatives. However, I'm actively reevaluating because after the sustained period of underperformance, which I think we had hoped for and expected, but not entirely predicted, it's worth looking at them again. Now, if you look at pipes, fittings, ceramics, paints, adhesives, all these other things, and then you layer on top of that housing finance, we can only invest in so much. But there's so much going on here. You listen to their commentary, you look at the revenue growth, and it's not, the revenue, as you know, is a function of both price and volume. Volumes are high, and we know they're going to be high for a long time. The pricing has been more resilient than we would have expected. And on top of that, these companies have been very intelligent about the operating leverage. But again, this is another one of those sectors where you can't buy everything. You have to do your homework. But the dispersion is there, it's available, the alpha is there.
When you say you're betting on India manufacturing, you know, a lot of sectors are now opening up. There's defense, there's railways, etc. as well. Are you skewed towards largely auto manufacturing, or have you also broadened your portfolio?
That theme is more broadly reflected in the portfolio than it has been ever. So it is infrastructure, it is defense, it is anything associated with rails is exciting to us, and we're spending time on that. It's two-wheelers, it's four-wheelers, it's commercial vehicles, there's agriculture equipment. All of that is reflected in the portfolio. And I think this is just, we're closer to the beginning of the beginning than the end of anything when it comes to the shift. Because there's the domestic demand, there's China plus one, and there's also, and that China plus one is not confined to any one sector. You're going to see that in healthcare, you're going to see that in clothing. Over the longer periods, you might even see that in semiconductors, although I think that's going to take a lot of time and a lot of capital. So we don't need to talk about that today, but it's going to happen again and again. It's actually quite exciting to see. I confess I was skeptical 2 to 3 years ago about this because you look at the power infrastructure, the logistics infrastructure, and I think any rational person would think this story is going to play out over a longer period of time than expected. But you look at smartphone manufacturing and all the other sectors we just mentioned, it's all happening. It's quite real. It's very exciting to see.
So this is all the good. What is it that you dislike about the India market?
As a market as a whole, I think, okay, well, let's start with valuation.
Yeah.
Well, India is probably the one market where we are least dogmatic about valuation. We have learned our lesson decades ago that if you just buy the lower PE, lower PB stocks, in absolute returns, you won't make much money and you'll horribly underperform. So we're not dogmatic about valuations. I would say as a broader market, and for many of the companies we've talked about, the sectors we've talked about, the valuations are pricey, not expensive. There's a difference, right? Expensive, there's risk to your capital. Pricey, it's because that's where the earnings growth is. So broadly, valuations, I'm not so concerned. Now within that, you look at some retail companies, consumer discretionary companies, some of the healthcare companies, those valuations are genuinely expensive and we're staying away.
So this is all the good. What is it that you dislike about the India market?
As a market as a whole, I think, okay, well, let's start with valuation.
Yeah.
Well, India is probably the one market where we are least dogmatic about valuation. We have learned our lesson decades ago that if you just buy the lower PE, lower PB stocks, in absolute returns, you won't make much money and you'll horribly underperform. So we're not dogmatic about valuations. I would say as a broader market, and for many of the companies we've talked about, the sectors we've talked about, the valuations are pricey, not expensive. There's a difference, right? Expensive, there's risk to your capital. Pricey, it's because that's where the earnings growth is. So broadly, valuations, I'm not so concerned. Now within that, you look at some retail companies, consumer discretionary companies, some of the healthcare companies, those valuations are genuinely expensive and we're staying away. So there's the valuations, there's the revenue and earnings growth. In the short term, I know that every year the expectations start high. We usually end 0.9x or 0.8x of that earnings cuts come through. But in aggregate, it's if you trace the arc of India's earnings growth story, it still goes from the bottom left to the top right, and that's going to continue for a while. So earnings, again, I'm not so concerned. I think what we have realized is we continue to need to do our homework. This is not a market, despite the very long-term tail to growth, that you can just buy and hold blindly. If you look at from 1997 to 2022, if you look at let's compare the Hang Seng and the Nifty. Okay, from the China transition of the transition of Hong Kong from the British to the Chinese, Hang Seng index was flat in that time. You had some companies that outperformed, some underperformed, but broader market flat. The Nifty was up 15x, and you had some companies in there that were up 50, 60, 70, 80 times. But you also had a lot of companies that are no longer around anymore, or they badly underperformed. And so you have to get comfortable with the market, the management team, the accounting, the governance, the shareholder disclosures. And when you do that, there's so much to look at. It's quite exciting still. So I know you.
So valuations is one part.
Yeah.
What else sectorally you have zero exposure to, besides the new age fintech companies in the listed universe?
Where do we have zero exposure?
Yeah.
I think property is the main one, and where we have been reducing exposure is in the staples side. I think that is more, for us, shorter term is measured more in, I would say, a couple of years, or maybe in quarters. It's not so much days, weeks, or months.
Or months, yeah.
But I think in consumer staples, there's reason to be less excited today. So
Why is that?
It's not just about the valuations, but if you look at the purchasing power, the shifting trends in spending, whether it is movie theater tickets or it is noodles, instant noodles, toothpaste, what you're seeing is that there is strain in the portfolio or in the wallet of the mass consumer. And that's not permanent, but if you layer on top of that the valuations that we see better opportunities elsewhere.
Well, I don't know really, because the urban consumer continues to spend, be it numbers from a trend, which is Zara, or for that matter, the load factor for most aviation companies. Airports are as crowded as they never have been, even pre-COVID, or for that matter, even if you look at some of the hotel companies and the kind of numbers that they have come up with. So it really seems like there is a specific section which continues to spend and spend more. but maybe it's not across the board.
It's not across the board. So
Yeah.
this is the right point. And we're seeing this across sectors around the world. If you look at the premium segment versus the mass segment, and the ability for players at the top to have pricing power, it's actually quite surprising. And it's exceeded my expectations. So the hotel rooms you talked about, if you look at the highest category rate at the highest end hotels in India, all full before the lower end. Occupancy rates are high, spend per person is high, and that doesn't look to change anytime soon. If you look at cars, the bookings for the higher price points are higher. And that continues. So again, it's these consumer staples names, large fixed costs, large distribution networks, reliant on volume more than pricing, they're suffering right now. And then you layer on top of that the valuation. This is one sector where I don't think the earnings shortcomings are yet in the price.
You talked about, obviously, consumer staples. You talked about large banks. But why QSR? Again, would you say that that's a substitute of the same, rationale that we were just talking about? People are not going to spend as much, and the consumer is getting a little price conscious.
I think so. The QSR is one of those stories. It fits in. I think when we speak again, whether it's a year, 2, 3 years down the road, this is probably one category that will have moved from the area where I'm less interested today to active shareholdings, because I think this is one area where the long-term story is very exciting. There are leading players. Some have domestic brands. Others are importing Western brands into India. And the footprint today relative to where they will be is quite small. The issue for them is this strain we're seeing in the consumer wallet, but then also on the cost side, the margin compression that we're seeing. I think it will take a few quarters for this to work out. When it comes to key food ingredients, when it comes to labor, the price of labor, that is going higher. It's still not high in the global context, but it's going higher. So I think the revenue growth will come. For now, there's a squeeze on margins that they need to work through. But it is an area where we are actively doing work, and I think other investors should as well.
Okay, so India you continue to remain bullish on at large, but ex-India, just at a global level, which is looking like the most exciting market, considering you don't only invest in India, but across the world?
I would say Japan in Asia, if we confine ourselves to Asia.
Sure.
When I look at the region, the geographic bookend, so South Asia, India, North Asia, Japan, I think those are the two equity markets with the longest tails to growth. Totally different markets, totally different drivers, but we are very excited about those markets. Greater China, our answer is the same today as it was midway through last year and 2 years before that. When we get asked, is China investable, are you excited about China? The China story is not going anywhere. We remain actively invested in China. Last year, we increased our allocation of capital to China, and it's an area where we continue to find opportunities. And so again, to go back to that June, July, August, September period last year, when there was such skepticism about China, that was a wonderful time to have been already focusing on China. I think if there's a looming sell-off in India, and this slight underperformance is not what I would categorize as a sell-off, but if it is looming, then I think we will have been rewarded for having been spending so much time on India. The fact pattern is very similar. The economies out here are large enough and they're diverse enough that they don't rely as much as they used to on the U.S. consumer. There's still a lot of reliance for manufacturing apparel in some sectors, but it's not as much of a reliance. Now, to answer your question about the recession, I think a lot of that was priced in last year. The rising cost of money, the rising probability of a recession. It's not something that I think about as often anymore. The price of energy and the price of labor, you can't entirely disaggregate that from the price of money, but rising interest rates and the price of money, these are things I spend less time on this year than last year. So there's a lot in the price. It's a very important market, but I think there's so much going on domestically in each of these key 4 markets that we talked about and in others that there's a lot of opportunities for investors.
New energy, how much can India actually benefit from this changing world order?
Hugely. I think the consumers will benefit. And what is interesting is how the directives seem to come from the very, very top in India. And it's clear the push in certain areas is very long-term and very well supported. Infrastructure, road infrastructure is one, energy is another, manufacturing is another. So I think that the consumer will benefit, the government is behind it. If you look at the new energy supply chain, most of the components today seem to be up in North Asia and in China. The real demand is here. This is more than just a decarbonization story in India. This is very much, there's a broader economic case to be made for all of this. And it's not just solar or just wind. Even if you get into some of the technicalities of it. So solar energy in India, the intensity of the sun here is more powerful than it is when it hits the solar cells in China.
Yeah.
So there's some science behind it that makes this market even better for that. So I think there will be a transition period as these manufacturing supply chains move to India and grow domestically. But new energy in India is going to be very large. It will be far larger than I was thinking about a couple of years ago. Now, reflecting on your questions, I'm thinking every sector has exceeded my expectations, and I'm generally pretty constructive. So I'm trying to think of one that might have missed. There aren't very many. And new energy is clearly one of those that has a very long tail to growth.
Okay. So continue to remain an India bull. That's the sum and substance of it, right?
20 years and going.
Yeah, 20 years and going. Thank you so much for
Thank
taking
you.
the time out and speaking with us.